Greetings, everybody. Welcome to Liberty Call. Today is Friday, August 25th, 2023. Hope everybody's having a fantastical day out there. You can see my buddy Jake back here. He is on duty, making sure everything's safe here at the DSA Financial Group World Headquarters in Colorado. So anyways, kind of a dreary day here. It is much cooler. I think it's about 60 degrees right now. I'm still wearing shorts, but I don't wear shorts or pants until October. I'm one of those holdouts. I will wear shorts and freeze until the cows come home. So anyways, much more green on the screens today. Yesterday was down, day before that was up, day before that was down. So just a back and forth week, a lot of volatility. I think, a lot of folks out there just trying to get a feel for where the market's headed, where the trends, is it trending up, trending down? We've been trending sideways for the better part of this year for the major indexes. So anyways, all right. Well, if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. And if you could do me a favor, you right there, press that like button, press the subscribe button, hit the notification bell, just so you know when I go live, because I'm sharing knowledge here, folks. All right, let's go ahead and jump into the numbers for today. Dow Jones was up 0.73%, 247 points, closed at 34,346. S&P 500 was up 0.68, closed at 4405. NASDAQ up 0.94%, closed at 13,590. The VIX was down 8.84%. It's currently at 1568. Canada was up 0.3, Brazil down 0.94, and Mexico was up 0.13. Headed over to Europe, Germany was flat at up 0.07, same with the UK. France was up 0.21%. Netherlands down 0.08, Spain up 0.15, Italy up 0.49, Switzerland down 0.18, and Portugal up 0.93. Russian exchanges both in the green today. The MOEX up 0.64, the RTSI fairly flat at up 0.03, and the overnights in Asia, kind of the inverse of the domestics, lots of red. The Nikkei in Japan was down 2.01%, Australia down 0.93, New Zealand down 0.83. In China, the Shanghai was down 0.59. The Shenzhen component down 1.23. The China A50 was flat at up 0.04. DJ Shanghai down 0.56. Hang Seng down 1.4. And the Taiwan weighted down 1.72%. So, all right. Well, let's go ahead and check out the week. See how things turned out for the week here. All right, we're starting out with the Dow Jones. Looks like it's going to finish the week in the red by about 0.51%. The S&P 500 is going to finish the week off up by about 0.58. The NASDAQ up about 1.25%. The Dow Transports down about 0.66. And the Dow Utilities up about 0.62. So it's kind of a mixed week here in the domestic major indexes. So let's zoom out and take a look and see how the trends are shaping up. So we can see starting here with this downtrend that began at the beginning of 22 for the Dow, broke the downtrend at the end of the year. And like I said, it's just been really trading sideways. We did have this uptrend here in the second quarter going into the third quarter, and we've really lost a lot of that rally. As you can see here, we've started to develop a downtrend, and it looks like, we're probably going to break through this line of resistance if it does here in the next couple of days. If we drag it out here, if it were to just kind of trade back and forth and consolidate, probably at the latest we would see it break that trend would be about mid-September, so about 2 weeks. All right, let's scooch that back over, and let's look at the S&P 500. Very, very similar chart. Started the downtrend last year at the beginning of the year. Didn't break through until early January, till the first quarter. Traded sideways for about a quarter, and then we had a nice uptrend here that developed in the end of the second quarter. But really, since the quarter began, it's been down, and we can see it's been lining up. And it looks like if they're going to cross on this one, looks like about the 1st or 5th of September. So again, the markets can do crazy things. It could continue to trend up. Let me drag this over. We might continue this trend line here if it doesn't break through this resistance. But if it follows this trend that it's currently making, it'll break through, like I said, probably in the next week or so. All right. Got to watch a little bit of charting. Isn't that exciting stuff out there, folks? I mean, you can see Jake back here. He is excited. All right, let me get this off my screen. And let's jump into the economic data that came out this week. Jobless claims, initial claims came in at 230,000, forecast 240. Last week's number was 240. Continuing claims came in at 1.702 million, forecast was 1.708. Last week's number was 1.711 million. Existing home sales came in under forecast at 4.07 million. Forecast was 4.15. Last month's number was 4.16 million. The month-over-month number, we show a 2.2% contraction. Last month's was a 3.3% contraction. And we can see here, looking at the chart, that we haven't had a positive month since March in the existing home sales. The S&P Global Composite Purchasing Managers Index, or the PMI, came in at 50.4. Forecast was 52. Last month's number was 52. New home sales came in at 714,000, above the forecast of 705. Previous number was 684. And we have a month over month. It actually grew by 4.4%. The forecast was only going to be a 0.2, so way over forecast. And last month's number was a negative 2.8. So, but it's been kind of back and forth with the new home sales. And that probably has a lot to do with contracts and things like that. Time of year as far as builders. I know in the South, they can pretty much build year round. I mean, there are times where it does get a little chilly and the ground, the weather doesn't cooperate. But, like where I live and there's snow on the ground half the year, it takes a lot longer to build a house. I mean, I've watched plenty of my neighbors build homes around here, and it takes about a year and a half. Just because, when the ground's frozen, sometimes you just can't work. All right. U.S. durable goods orders month over month contracted at negative 5.2%. Forecast was a negative 4. And I think that's it. Yep. It was a lighter week as far as economic data. So, all right, let's get to the market recap. S&P 500 pairs some gains after Powell warns inflation is still too high. All right. The S&P 500 continued its upward trajectory on Friday as investors took advantage of the tech dip following a surge in Treasury yields prompted by Federal Reserve Chairman Jerome Powell's hawkish stance on inflation control. Powell's speech at the Jackson Hole event emphasized the need for restrictive monetary policy to achieve the Fed's 2% inflation target. He noted that bringing inflation back to the target might require a period of below average economic growth and softening labor market conditions. That sounds like a recession to me. What do you think out there? Give me a thumbs up or a thumbs down. All right. As Treasury yields rose in anticipation of prolonged higher interest rates, tech sectors faced pressure due to their relative higher valuations. Both Google and Meta initially experienced losses, but regained momentum as dip buyers entered the market. Marvell Technology suffered a 7% decline, affecting gains in the chip sector. Despite beating Wall Street estimates in their quarterly results, Marvell's downward outlook on memory demand due to their AI-centric product launch impacted their stock. NVIDIA Corporation also weighed on the broader tech sector as investors sought profit-taking. Despite its positive quarterly results that surpassed expectations, NVIDIA stock, which had surged over 220% this year, saw some selling. Gap emerged as a winner with more than a 6% increase despite mixed quarterly results. Despite a cautious consumer outlook and weaker second quarter revenue, Gap's positive performance showcased investor confidence. Maybe back to school might be helping. People buy clothes this time of year. Meanwhile, Ulta Beauty faced a more than 3% drop even after exceeding quarterly expectations and raising annual guidance. Some concerns about the sustainability of high beauty product demand amid a weaker consumer trend. All right. And last, UBS indicated that while the strong demand for beauty products in the beginning of the year might moderate, Ulta Beauty is likely to fare well in the long term due to its efficient supply chain, operational investments, and profitable e-commerce business model. Good stuff. Good stuff. All righty. So let's see here. Okay. Oops. What'd I do? Let me turn that off. All right. Next up on the docket comes from Zero Hedge. More Americans are having a hard time paying their credit card or their big credit card bills. That is not good. And I was in the credit and collections field for basically a decade after I got out of the service. And you can look at the queues and see how they get bigger and bigger and bigger. You can, it gives you a kind of a foretelling of, what the economy is doing. And because I was in the credit and collections during the .com bust at the, right around the Y2K and all that stuff. And we thought it was going to be a big problem, but it did definitely, with people being out of work and those, the market's not really cooperating. It did put a strain on the collection queues at the time. Anyways, all right. As inflation surged in the aftermath of pandemic-induced stimulus measures, Americans have faced financial strain, rapidly depleting their savings and increasingly relying on credit cards to make ends meet. A new development highlights the growing struggle. The number of Americans carrying credit card debt from month to month has now surpassed the number of those who pay off their bills in full, marking an unprecedented trend. Not good. With over $1 trillion in credit card debt, the situation is escalating. Between April and June, credit card balances spiked by $45 billion, and interest rates have climbed to a steep 20.6%. This combination of higher balances and increased interest expenses is causing more individuals to face difficulties in settling their credit card bills. A J.D. Power survey revealed that 51% of U.S. credit card holders now carry revolving debt, compared to a range of 40 to 50% from 2018 to 2022. The average credit card balance in June was $2,573, reflecting a 6.5% surge compared to the previous year. And when you work in a collections department, you see like $10,000, $15,000 unpaid debts. I mean, the worst are people who will go out and, get issued a card and just run it up. If it's a $10,000 or $15,000 limit, just run it up, never make a payment. Sometimes they charge their bankruptcy retainer on the card that they're going to file bankruptcy on. I've seen that too. It's hilarious. That's when we send it over to the attorneys, and then they sue the hell out of those people. All right. The spike in delinquent accounts further underscores the challenges Americans are facing with credit card payments. Over the past 2 years, the number of accounts past due by one cycle has risen by 42.6%. Well, what was the previous number? I'd like to know that. Delinquency rates have reached their highest point since 2017. As savings cushions established during the pandemic are depleted and economic uncertainty persists, consumers are relying heavily on credit cards to cover everyday expenses, particularly for grocery shopping. However, a sudden decline in credit card spending was observed in June as revolving credit, primarily credit card debt, contracted by $600 million, down by 0.6%. This decline in credit card spending raises concerns for the U.S. economy, given that consumer spending constitutes about 2/3 of the nation's economic activity. The situation reveals a pivotal question: what happens when consumers max out their credit cards? The reliance on credit cards amid financial strain challenges the idea that the Federal Reserve can control inflation while orchestrating a soft economic landing. I've been saying all along they're not going to do that. In essence, this trend indicates that the stimulus checks have been spent, savings are being rapidly exhausted, and credit cards are being pushed to their limits. This unsustainable trajectory may lead to a significant impact on consumer spending patterns and the broader economy. All right. Yeah, I am not sympathetic to people who run up debts and don't pay them back. I spent, like I said, about a decade hunting these dirt bags down. Granted, not everyone's I was very polite and nice to people who, lost their job or got sick or, things happen. It's totally understandable. But when people are just complete jerks about it and are like, I'm just not going to pay you, that's when I get we get pissed. So anyways, and I had a thought and it just out of my head. All right. Well, last up, let's go on to from Mises Wire, titled "Government Imposed Competition Harms Competition," written by Daniel Kowalski. Okay. All right. A recent White House executive order by Joe Biden aims to uphold economic freedom by means of government intervention. That's not freedom. Attempting to regulate competition. While the president's emphasis on competition is commendable, the best route to fostering competition lies in reducing regulations rather than augmenting them. Government intervention often hampers the efficiency that drives successful businesses, leading to unintended consequences for consumers. Historically, successful businesses like Standard Oil and Walmart achieved dominance through relentless efficiency and vertical integration. These strategies led to cost savings, better products, and ultimately market leadership. Standard Oil, for instance, manufactured its own barrels and railroad tanker cars, circumventing third-party suppliers, markups, and costs. Walmart developed an exclusive distribution network that enhanced inventory management and maintained competitive prices. Kind of like Amazon. They get stuff to you in like a day. I ordered a French press. My old one had wore out, and it was here today or yesterday, and I got to use it this morning. All right. Where was I? However, the current trend towards government intervention contradicts these successful models. Politicians call for regulations to enforce competition and often lead to fragmentation, inefficiency, and higher prices. And there's usually some handouts for buying votes, which I get sick of paying for as a taxpayer. This approach might involve forcing businesses to spin off their assets or adhere to approved third-party suppliers. Such practices hinder innovation, disrupt efficiency, and negatively impact consumers. Promoting competition doesn't necessarily require heavy regulation. In fact, small businesses can thrive alongside behemoths through specialization. Walmart's founder, Sam Walton, advocated for smaller businesses to focus on specialized markets that large corporations couldn't effectively cater to. Similarly, Amazon's rise disrupted established retailers, demonstrating that market dynamics evolve and smaller businesses can seize opportunities in specific niches. Government regulations impose significant costs on businesses, hindering competition. Complex rules on issues such as worker compensation insurance and licensing fees create barriers for entrepreneurs. Compliance consumes time and resources, I can tell you that. Diverting attention from core business operations, innovators like John D. Rockefeller of Standard Oil capitalize on transparency and efficiency, which allowed them to outcompete rivals. And not that Rockefeller was the greatest person. I'm sure he was an evil dirtbag too, but I mean, he was in cahoots with the powers that be that ran this country, so I don't think he's perfect. Government intervention stifles innovation and economic growth. The core of competition is relentless innovation and work ethic. For instance, Standard Oil's competitive advantage lay in its unwavering pursuit of innovation and efficiency. Government interference would have hindered such progress, negatively impacting consumers by favoring less competent competitors. Well, Mr. Rockefeller probably would have just bought off the politicians at the time. He had more money than God. A different landscape might have emerged if regulators had curbed Rockefeller's success for the sake of smaller competitors. Genuine competition arises when regulations are reduced, enabling companies to thrive based on merit, innovation, and efficiency. The focus should be on fostering an environment conducive to fair competition rather than tilting the playing field with more rules. Ultimately, the true path of competition lies in encouraging a level playing field through minimal interference. Unfortunately, the current policy direction in Washington diverges from this principle. Rather than augmenting regulations, policymakers should seek to create a business environment that spurs innovation and rewards efficiency, leading to authentic and sustainable competition. But do you think that's going to happen? No. They'd rather, mess with it, get their fingers all in it, and, make it look like they're doing something, and then say, look what I did. Kind of like with the Fed right now. It's a perfect example. The Fed and our government, printed $5 or $6 trillion 3 summers ago, and then stood around and said, inflation is transitory. It's no big deal. Don't worry about it. And then now they're like, oh gosh, look what happened. But hey, thank us. We've raised interest rates, which have brought down inflation. So give us a pat on the back. Nope. I say the gallows are the only way to effectively fix this problem, but most Americans are just pussies. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful weekend, and I'll talk to you next time. Adios.